Meanwhile, home buying activity picked up slightly in November as mortgage rates began to fall, albeit very slowly. Total existing home sales inched up 0.8% in November on a seasonally adjusted basis when compared to the previous month, ending a 5-month streak of monthly declines. It comes as the housing market is still pretty much stalled in the last year due to high rates and home prices. Here to break down what these new stats may mean for the industry is Lambert, CEO and co-founder at ResiClub. Lance, always good to see you on this issue. Here's what struck me, Lance. So existing home sales, they rose by 0.8% in November. It was just ahead of October's level. The economist at the National Association of Realtors, Lance, sees what he calls a marked turn higher in existing home sales going forward. That strikes me as pretty optimistic talk, Lance, but I'm interested to get your take.
Yeah, when you look at the actual number of transactions that are occurring right now in the existing housing market, there's not a lot occurring. That 3.8 million number that's seasonally adjusted, that's very low. That's about as low as you can possibly go. And it's really just, still the transactions of like death, divorces. But what's been sucked out of the market are people like selling their home to go buy something new because of a lifestyle change, or they just want more space. They're only doing it if they have to do it. And the reason being is that affordability is very strained, with mortgage rates having gone up from 3% to 4% to 5% to 6% to 7%, and then hitting this fall at 8%. So the reason that some of the housing economists like NAR are getting a little more optimistic is because that affordability, which has been a burden on the housing market and has kept transactions very low, is starting to loosen up. We've seen some affordability improvements with the average 30-year fixed mortgage rate going down from what was 8.03, a 23-year high in October, to now, as of right now, it's 6.64 according to Mortgage News Daily. So that's creating some affordability improvement. I mean, for the typical buyer of a mortgage around $500,000, that's about a monthly improvement of $400 a month. So it's nothing to scoff at. It's definitely an improvement to affordability. And the other thing is we're now moving into the seasonally stronger window of the year, moving into that spring season where some of the people who maybe have put off selling a home because they didn't want to give up their 3% mortgage rate for a 7 or 8 might now reconsider. Now that we've been here for a while, they maybe had some lifestyle changes, maybe had another kid, and they're like, you know what, if I can get it down to 6 something, or if I buy down the rate and get it to a high 5, I'll do it. And so the industry's hoping that we'll start to see some of those sellers come out and some more of the buyers who've been priced out come back in now that rates have come down to the mid-6 range.
So, Lance, there certainly has been some loosening, especially when you take a look at today's data. We know that you have your own data as well. Does your data line up with, say, where we're putting a pin in this and you see some unlocking of demand, not just because of the seasonal changes that we typically see in the spring and summer when it comes to the housing market? Is this a turning point that we're starting to see?
I think what we're seeing is that most of this is going to be seasonal. We're going to see a seasonal uptick. But if rates stay here, if we stay here for duration and we stay in the mid-6s and don't go back up into the 7s, and consumer confidence starts to realize, hey, maybe we aren't having a recession here, I think we'll start to get existing home sales moving up a bit. The question is just how much can that number really move up, with affordability still being strained and there still being some type of lock-in effect in the market. But it does feel like that the worst could potentially be behind us for existing home sales and that volumes will hopefully start to move up. The question is just how much of an uptick we will see.
And Lance, let's just dig into affordability a little bit more. You know, Mortgage News Daily, Lance, they're saying the 30-year fixed is at 6.64%. You talk to a lot of smart folks. Where do they see that heading? You know, 6 months from now, could we be testing, 5.5, even 5%?
Yeah, that is a great question. And so as financial markets loosen, like we've seen over the past 2 months, and the 10-year Treasury yield comes down, and the MBS market gets more activity, you can see those rates come down. The question is just going to be how much of a loosening do we get? If the economy holds firm and still remains strong and the Fed doesn't cut really fast, it's possible that yields and mortgage rates could stay elevated for a prolonged period of time. although there's the possibility that the spread between the 30-year fixed mortgage rate and the 10-year Treasury yield, if that were to start to normalize as the Fed starts to cut rates, right now the gap is around 2.7 percentage points, and it's normally 1.7 percentage point. So if just the spread alone could normalize, we could see mortgage rates down to 5.64 just with a normalized spread. So there's a lot of things to be looking out for next year. The biggest question is how fast does the Fed actually cut? And the second is do financial markets start to ease and the spread between the 30-year fixed mortgage rate and the 10-year Treasury yield start to normalize?
Yeah, we'll certainly be looking to see what that when that normalization pans out. Lance Lambert, CEO and co-founder at ResiClub, thanks for joining us as usual.